Now, as we head into the overnight session and tomorrow, on the upside, the resistance at 55.18 to 32 is still intact. And then we have strong resistance at 55.37 to 43.5 and 55.56 quarter to 66 quarter. Those are still zones where sellers can be active. The market is, of course, quite overextended to the upside. Our intermediate term bias is still going to be bearish. Our bigger picture will remain neutral bearish, and our short term will likely now switch to neutral because of today's big rally. Again, it's a very news-driven market environment. I personally don't think that we are out of the woods just yet. That's why I'm leaving the intermediate term bias as bearish, and that's why I'm also leaving the bigger picture as neutral bearish. If we take a look at the larger time frame chart over here, you can see that the market is essentially getting very close to the bottom of this balance that we broke down from, and I expect there to be a lot of friction if the market pushes up into this balance, and I think it's going to take much more time to process this multi-day balance area that we broke down from. If we take a measurement of the larger swing on the daily chart, you can see that this balance area, or the bottom quadrant of the bigger balance area, marks the 50 to 61.8% retracement of the bigger swing that happens to be in play. And that's yet another reason to expect a lot of friction over here. See, this kind of movement is much easier when the market is way overdone to the downside and you only have a couple of days of balance to work with. So you can get this. But what got us from here to here is not what is going to take us from here back up to here. This, I think, is going to take much more time for the market to process and work with. So this, as much of an outlier move as it is, it's still actually kind of within reason in a way, which is really odd to say for a 648 point move. But from a market structure perspective, it's not unreasonable for the market to rally back into the balance breakdown area. The only unreasonable thing is how quickly it happened. But over the course of a few days, normally this is still okay. Like, the fact that we're back up here is not that much of a shock. Usually it just takes more time for it to happen, but because we're running on high volume, high volatility, news-driven movement, fine, it happened in a single session, right? That's the only surprising part. But the fact that we're back here is not surprising. Many times the market does this. It just usually takes more time. So I would expect this area to still be a friction point in the market. And even if we bust through it and go higher, I think that you will still end up seeing rejections on the way up as the market deals with this balance area and the resistance areas that are built into that balance area. So the higher the market pushes, the better the resistance it will run into. But right now, the most relevant active resistance is going to be 55.37 to 43.5 and 55.56 quarter to 66 quarter. I think when you have this kind of technical damage that has already been done, it just makes it much more difficult for the market to sustain higher prices. Again, what got us from the support all the way up into the resistance is not what's going to get us from here all the way back up to 57.12 quarter. This is going to be much more difficult in my opinion. So it's going to create a more challenging market environment because the more relevant or the more consequential areas of support are going to be quite lower. So I think that as we head into tomorrow, it's probably prudent to focus more on preserving capital rather than maximizing gain because the market is a bit nuts right now. It's easy to lose money in this environment. It's easy to get sucked into the emotion of it, the excitement of it, and start deviating from your process. And I hope that this recap serves as just a reminder to stick with the process, not get sucked into the emotions of it, and just try your best to remain even keeled, even if that means not taking trades for a day or so. Understand that the markets aren't going anywhere, the volatility is not going anywhere. I personally don't want this level of volatility. I think the healthy amount of volatility would be an average range of maybe 150 or 200 points a day. Like that would be fantastic. That would give us plenty of opportunity without the insanity of 400-point runs. So I think that is going to be much more of a sweet spot, and we'll actually find significantly better setups under those conditions. So that's my perspective on the market right now. Let me see if there are any questions, and then we will wrap.